In this video, I will show you 3 proven strategies to boost your $100,000 stock portfolio safely. That's when you don't want to take many risks, but you want a reasonable return for your investments. My name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 24% per year. So let's start from the beginning. If you have a $100,000 portfolio, stock portfolio, and you want to invest safely, without taking many risks, the first thing I would recommend, especially if you don't have much time, is to only invest in Berkshire Hathaway. That's a very simple answer for you, but Berkshire Hathaway is the conglomerate of Warren Buffett, and he has been delivering good returns safely. So let's say you have a 10% guarantee if you invest in this stock. You can get slightly better returns compared to the S&P 500, and you are associated with great management, the best management team, maybe the best management team in the world. You have the best capital allocator, Warren Buffett, as a CEO of the company. So you are in a very safe environment. You have an astute CEO, and the legacy of Warren Buffett is very, very strong. So if you want to compound your wealth safely, steadily, for the long term, without stressing about it, just invest in Berkshire Hathaway. Put 100% of your portfolio in Berkshire Hathaway. Okay, so that's the safest way out of the 3. Now we'll get a bit more technical. Okay, the second way of growing your wealth steadily, safely, your portfolio, is to only focus on the growing industry. So growing industry, like the industries that will have a huge tailwind for the next generation, 5 years, 10 years. I'm talking about AI, robotics, tech, digital marketing. Take all these industries. Many of them will thrive, many of them will lose, but on average, don't focus on declining industries. That's my point. Don't focus on the automotive industry. Don't focus on the publishing industry. These are declining industries and they don't work very well in terms of return on capital investments. So growing industries, and you only invest in the best one. The best one. So the best companies out of this list of growing industries. So you can have a portfolio of 10 stocks. You take the 10 best industries of the world that you think will grow for the next generation, and you see who is the best player, who has the better margins, who has the better return on invested capital. And once you have figured out who are the best, you buy them at a reasonable valuation. I'm not talking about buying them at any price. Don't buy Tesla at any price, Nvidia at any price. Buy them when they are trading at a cheap price, but if they are the best, they will rarely be trading at a cheap price. So buy them at a reasonable price. That will be reasonable price. So you take the growing industry, so you have a big tailwind for the future, so you are helped, you are in a good environment. Then you take the best one, so you have a double help, and you buy them at a reasonable price, a triple help. These are 3 tailwind that will make great returns for the long term. I'm not telling you everything will succeed, but on average, if you focus on growing industry, growing businesses at a good price, it will work well. And that's a safe way to make money for the long term, because you are invested in the best ones. So there is a lower probability of going bankrupt or of completely failing. So yeah, and monitor them along the way. Every year you monitor if they are still the best or not, if competition is working out as you thought exactly. But that would be the second way of growing your portfolio safely for the next 5 years, 10 years or more. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of this video. And the third way is more concentrated, less diversified across industries, is to focus on dividend stocks. There are some stocks that give dividends every year. They have been paying dividends for 2 decades, for 30 years, but these are not growing businesses. Like, not a lot of growth. You won't find exponential growth for these businesses. So these are businesses with either stable earnings, absolutely no growth, or the reasonable growth, let's say 5% growth. You have Coca-Cola generating 5% growth. That's decent. So 5% growth, but they also have, some businesses have a 5% dividend yield. So dividend, I have a pad, so yeah, okay. Dividend yield. And that's how you can get some good returns. Most of the time, these dividend stocks are not trading expensively. These are trading cheaply or raised at a reasonable price. So it won't get fancy. It won't get hyped by the market. So you can get them at a pretty good price, at a pretty good moment, regardless of the year, the election year, the inflation. These are stocks that are not hyped by the macro, by the environment. They have some good growth, reasonable growth, 5% growth over the long term. And what is good about these businesses is that, yes, they grow 5%, but they have been growing 5% for 50 years. So literally, you have no cyclicality, no stress. These are old businesses, mature businesses that have been growing slowly for decades. So there is a high chance that they will grow slowly for decades in the future. So this is the way to grow your portfolio safely. And you have a dividend yield. I have taken 5%, but maybe you can get 6%. 6 and 6%. So that's 12% growth for your portfolio. Or 6 and 7, you get 13%, or even more. You can twist the numbers. So how you can do it concretely, you take a big screener. You have free screeners online or paid screener if you want advanced metrics, and you filter all the companies, and you only keep the companies that have a dividend yield higher than 4%, higher than 5%. Out of this list, you want to only invest in, oh yes, I forgot, in developed markets. So this is really important actually. In this one, you have developed market. We are talking about growing your portfolio safely. So you don't want to make a bet in an emerging market and then they have political turmoil and there is a mess. No. Just keep investing in either Europe or the US or Canada or Australia, maybe Japan. But if you can avoid Japan and Korea, in China, all these Asian companies, the culture of dividends is favored for the US and Canada and Europe. So keep with developed countries, all the companies that have been generating dividends year after year. So you take your filter the emerging countries, filter the companies that don't pay dividends. You want dividend yield of 5% or more. You want growth rate, so earnings growth, revenue growth of 5% or more, and you will get some companies, some hundreds of companies, and you select the best one. And as you move up the threshold, it could be 6%, you will get filter out and you will only keep the best. And you get 7% growth, 7% dividend yield, keep the best one. And you want to buy them at a valuation, let's say you want to pay a PE ratio, so the price earnings ratio, lower than 15. Let's say reasonable. Either way, it won't matter much because there will not be multiple expansion over the years. But PE ratio over 15 for companies that pay dividends, that have been paying dividends for decades, growing nicely, steadily for developed markets. So these are 3 proven strategies that can grow your $100,000 stock portfolio safely over the next decades. If you like this content, I have an investing coaching program to make you a better investor. In this coaching program, you will learn a complete investing process. You will learn how to find stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. So what comes with the coaching program? You will get access to an exclusive community of like-minded investors, and you will get my personal guidance to help you build the portfolio of your dream so that you can have long-term results with your stock portfolio. Click the first link in the description to get more information. You will get a 10-minute video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.